Will interest rates go down in 2023? That is the question on everyone's mind, and that's exactly what we're talking about today. But first, what are interest rates? Who sets them? And how does that affect your cost of home ownership? Well, interest rates are the cost of borrowing money, but not just home loans. You see, the interest rates I'm talking about, they affect every aspect of your life. Interest rates are determined by the Federal Reserve, which is the central bank of the United States. And the Federal Reserve's Monetary Policy Committee, they decide whether or not to raise rates or lower rates. But the interest rates set by the Fed, they're not the same as the mortgage interest rates that you're probably thinking about a home loan. See, in this video, we're gonna break down exactly what that means, its effect on mortgage rates, your cost of home ownership, and of course, answer the question, will rates go down in 2023? And we're gonna get after it right now. If this is your first time to the channel and you want to know everything there is to know about eating, sleeping, working, playing, the good and the bad of living in Atlanta, Georgia, well, subscribe below and ring the bell for notifications so you can be the first to know about the current market and when we release new videos just like this one. My name's Denny. The team and I get calls each and every day from people just like you looking to make the move to Atlanta, and we absolutely love it. So whether you're moving next week, next year, or anytime in between, call, text, email, schedule a Zoom, and we'd be happy to help you make a smooth move to Atlanta. As I mentioned in this video, we're gonna break down what all that means to you, its effect on mortgage rates, your cost of ownership, and will rates go down in 2023? See, interest rates, that's the cost of borrowing money. It affects every aspect of our lives, from how much you pay for a mortgage to what you pay for groceries and even gas. You see, interest rate is determined by the Federal Reserve, again, the central bank of the United States. It's made up of 12 members, and they meet regularly to decide whether or not they wanna raise or lower the Fed fund rate. And it's based on a lot of economic factors like inflation, unemployment, and GDP growth. I think you'd have to be hiding under a rock not to know that we've had an inflation issue for the last couple of years. But here's a chart of kind of the adjustments that the Fed has made over the last couple of decades. Now, the Federal Reserve, they use their monetary policy to influence economic growth by raising or lowering rates, which affects how much money businesses and consumers like you and I have access to when making investments or taking out loans of any kind. So by increasing the borrowing cost for consumers and businesses, it makes saving more attractive than spending, and ultimately that is what limits consumer and business demand for goods and services. And obviously when you limit that, it slows the economic growth, but it can also be used to pop bubbles caused by artificially really low rates after a period of rapid inflation, which happened in 2001 and 2008, and the current COVID bubble as well. You see, when interest rates go up, it becomes more expensive for businesses to borrow money, which drives up the cost of doing business, puts downward pressure on the economy and inflation and jobs. And so that's the part of the cycle that we're going through right now. When rates go down, businesses have better opportunity to borrow money, which is how we got into this mess to begin with. Easy access to cheap money, it creates job and economic growth, but it also creates inflation. And so the Fed, their job is really that of a balancing act. It's one I personally don't think they do very well. In an attempt to prevent bubbles and crashes through rates and monetary policy, they tend to amplify bubbles and crashes. So hopefully this time they'll get it right and we'll have a bit of a soft landing, but that may not be the case. As I mentioned, interest rates affect every aspect of our lives. The interest you pay on credit cards, auto loans, and even mortgages. So here's a historical chart of mortgage rates over the last 50 years. And as you can see, rates were over 18% in 1980, and they reached historically low rates in the last few years, as low as around 3%. And so here's the answer to the question you've all been waiting for. It's unlikely that rates will change dramatically in 2023. See, mortgage rates will most likely stay in the 6% range. Now, this is just my personal opinion, but it's backed up with a lot of experience and knowledge. So around 6%-ish for the rest of the year. Hopefully we've already hit the high of just over 7% last fall around October. It has crept up over the last few weeks. The Fed fund rate is currently 4.6, but it's projected to raise at least one or two more times in the near future and then pause for the rest of the year. Their target rate is at least 5% and maybe as high as 5.5. Now, I'm generalizing here, but the spread between the Fed fund interest rate and mortgage rate is historically about 1.5% to 2%. Could be a little more or less, but let's use 2%. See, back in 1990, the rate was about 8%, so mortgage rates were about 10%. Recently, the rate was near 0%, so mortgage rates fell below 3%. That means if the Fed reaches its target of 5+%, we should hopefully stay in that 6.5% to 7% range. Now, the mortgage industry is expecting that, so it really depends on the economy in the second half of the year as to what the Fed does. The Federal Reserve Monetary Policy Committee is likely to keep rates pretty steady as long as things don't change too much for the rest of 2023. There are some signs that the economy could improve or deteriorate really quickly, which is why we don't expect any drastic changes in the near future as the Fed continues to monitor things like inflation, GDP, and unemployment data. Inflation has kind of cooled off a little bit. It's not where they want it to be. GDP, they're not really talking about a lot. The unemployment numbers are historically very, very low, and they've said that they do want to put pressure on the economy and the jobs market. They'd like to see that around 5%. And so, like I said, I don't think they do a good job of getting exactly right. It tends to whipsaw back and forth, and so we'll see what they ultimately do. But I don't see rates going down significantly or up significantly from here for the rest of this year. Now, what happens in 2024? If you've been watching all of our videos, you know that real estate prices are kind of in the same boats, right? They're not projected, volume is projected to be down, prices are projected to hold steady. Some markets are down, some markets are up. Atlanta's doing really, really well. And so again, whether you're moving next week, next year, anytime in between, do call, text, email, schedule a Zoom. We'd be happy to help you make a move. And until we see you in person, we'll see you on the next episode.